Assalamualaikum, madam and friends. My name is Nur Fazana binti Zarusom. I'm the first presenter of our group, number 10. The topic is regarding about the financial plan. The financial plan, it can determine the effort to achieve strategic goals and economic potential venture. Usually, inside an organization, after they already determine the objective and vision, there will be they will create a financial plan for their organization. This plan provides an estimate of the potentials of the venture. It can estimate it based on a set of assumptions regarding sales revenue and cost. It's the best available informations and their intuitions. The organization can calculate the potential profitability of the venture. Furthermore, they also need to determine their flow of cash monthly to identify the cash investment that will be required for over 2 or 3 years period. Also, an income statement and a balance sheet are required to demonstrate profitability and liquidity. Using the estimates of sales, the venture team can determine the number of units it needs to sell to break even. Furthermore, it can calculate several measures of profitability that demonstrate the returns provided by its venture for investors. The best ventures grow sales consistently and provided positive cash flow and profit early in their life. So, as you can see, it is one complete cycle for organization to run the business as they will see the cash flow, as they can estimate when will they get the fund to their organization. It can measure their in outgoing fund, where the money go, where do they pay their money to, and they can have a backup plan to proceed the business for another month. In short words, the financial plan is a task of determining how the organization will afford to achieve its strategic goals by the idea of intents to meet the financial obligations and to maintain their venture's liquidity. Next is operating and capital budget. Operating is a process of evaluating investment and huge expenses in order to obtain the best returns of investments and for business to run efficiently as possible. All kinds of business need to oversee the designs and management of behind the scenes work. It is developed before the organization developing the pro forma income statement. For sales budget, it is known as a measure of the expected volume of sales per month. Sales budget is a financial plan that estimates a company total revenue in a specific time period. It focuses on two things: the number of products sold and the price at which they are sold, to predict how the company will perform. The sales budget is a planning tool that allows companies to manage resources and profits based on the expected sales. It takes into account previous sales pattern and budget for similar time periods so that each department can have a big picture idea of where they stand financially. It also can make the organization be more efficient in reaching their goals and maximum their profit. As you may see at the picture of the example of manufacturing budget for the first 3 months, it only shows the projected sales, desired ending inventory, available for sales, beginning inventory, and total production required for January, February, and March. The detail was not so into like the operating budgets for the first 3 months. Next is operating costs. Operating costs required to maintain the day-to-day operation of business. It already includes fixed expenses of sales volume such as equipment, rent, raw materials, salary, payroll, marketing, insurance, and other overhead costs. The expenses need to be tallied with the strategy in the business plan. So for the capital budget are provided from basis evaluating expenditures that can lead the organization to run for more than 1 year of the business. Capital budget is a process of evaluating investment and huge expenses in order to obtain the best returns of investment. An organization is often faced with the challenge of selecting between two projects or investment, or to buy or replace the decision. Ideally, an organization would like to invest in all profitable projects, but due to the limitations on the availability of a capital, an organization has to choose between different projects or investment. Capital budgeting as a concept affect of our daily life. As you may see in the picture, there is an example of operating budget for first 3 months. In the details of expenses for the month of January, February, and March, you may see the business license, education, insurance, rent, offices expenses, software, subcontractor. All the details need to be written down inside the operating budget for first 3 months of the organization.
Sales forecasting. Sales forecasting is an estimate measurement of how a market will behave to a company's go-to-market efforts. Most startups will rely more on qualitative methods. There are two types of sales forecasting. Firstly, short-term sales forecasting, and secondly, long-term sales forecasting. There are four elements of sales forecasting. Firstly, accuracy. The previous method must be monitored for one of accuracy by observing that the forecasts made in past are accurate or not. Secondly, simplicity. This method should be easy to understand and simple, which can satisfy the top management persons. Thirdly, availability. The forecasting technique must be able to produce meaningful results. It is also should easy to implement. Then lastly, economy. Cost is the most significant factor, so the method adopted should borrow a minimum cost. Benefits of sales forecasting. Firstly is provide a forecast for raw materials. Second, easy risk management and business planning. Then, management of cash flow and utilization of the company's resources. Then, identifying early warning signs for the long-term goals of the company. Sales forecasting allows companies to, firstly, predict achievable sales revenue. Secondly, efficiently allocate resources. Thirdly, plan for future growth.
Pro forma income statement. What is pro forma income statement? Pro forma statements are useful with regard to tracking future financial direction and occurrence, often including some historical numbers to help account for what the projected outcome should look like. Pro forma statement allows a company to see the need for change in its operation to prevent decreased profitability. Pro forma income statements are very important because of the information they can offer a company. The financial statements can help forecast if producing the new goods will cause expenses to increase. This enables the company to accommodate any potential for profit or loss by changing production strategy, materials, or even the rate or timing of the production of the goods. What includes in pro forma income statement? Its projected net profit calculated from projected revenue minus projected costs and expenses. Projections of all operating expenses for each of the months during the first year should be met. Increase in individual expenses need to be reflected in the first year pro forma income statement. Projections should be made for years 2 and 3 as well. It's considered expenses that are likely to remain stable over time. Use year 1 as basis. Make assumption about changes between year 1, year 2, and year 3. This is example pro forma income statement. Sales minus cost of sales got gross profit, and then minus operating expenses got operating income, minus financing expenses, and we'll get net profit before tax. Pro forma balance sheet. What is pro forma balance sheet? Pro forma balance sheet is similar to a historical balance sheet. It represents a future projection. Pro forma balance sheets are used to project how the business will be managing its assets in the future. It summarizes the projected assets, liabilities, and net worth of the new venture. What consists in pro forma balance sheet? Have three: asset, liabilities, owners, equity. In asset, items that are owned or available to be used in the venture operation, such as current asset, fixed asset. For liability, money that is owed to creditors, which is current liabilities or long-term debt. For owner equity, amount owner have invest and or retained from the venture operation. This is example format pro forma balance sheet that have assets, fixed asset, liabilities, long-term liabilities, and owner equity. Pro forma cash flow. Pro forma cash flow is a statement helps companies project their cash inflows and outflows over specified periods. It helps business plan for the future by setting budget or compare the different financial strategies. Projected cash flow available calculate from projected cash inflows minus projected cash disbursement. It's not the same as profit, and sales may be not in cash. Its use of profit as measure of success may be deceiving if there is significant negative cash flow. We use direct method cash flow. Why must entrepreneur have to do monthly projected of cash? It's because disbursements are greater than receipts. Entrepreneur must either borrow funds or have cash in a bank. Can establish lines of credit to borrow against and be sure maximums are not exceeded. Third, large excess positive cash flow needs to be invested in liquid investment with higher yields. Here are the example format for pro forma cash flow for direct method.
Break-even analysis. Break-even analysis tells you how many units of a product must be sold to cover the fixed and variable costs of production. The break-even point is considered a measure of the margin of safety. Break-even analysis is used broadly from stock and options trading to corporate budgeting for various projects. How it works. For example, some small business, it has a fixed cost. Rent, salaries, cost for raw material. Break-even analysis shows how many sales it takes to pay off the cost of doing business. And the additional sales will become profit. It is important to know the difference between revenue and profit. Every sale brings revenue, but only after sufficient sales made to pay off fixed costs due to additional sales revenue would bring profit. Break-even is equal into fixed costs divided by price per unit charged to customers minus variable costs to produce each unit. Software package. Why we need it? Having a plan for your finance is crucial, and a comprehensive financial plan may include budgeting, saving, investing, paying off debt, and creating a roadmap to retirement. Working with a financial advisor can be helpful in creating your personal money plan, but DIY types might prefer to use a financial planning software instead. There are a multitude of options to choose from, and each one has a different range of features. If you're a financial advisor yourself, there are also plenty of software options that you can use to help you build plans for your clients. Some of the features are the ability to link all your financial accounts, including retirement and investment accounts, in one place. Next, a net worth tracker, a tool to find hidden fees you might be paying for your investment. Other than that, budgeting and cash flows tools to track spending. Then goal trackers for your spending and savings target. Last but not least, tools for forecasting retirement and college savings outcomes. Microsoft Excel, a spreadsheet program, is most suitable for completing pro forma statements. It helps present different scenarios and assess their impact on the pro forma statement. A simple and easy to use software is useful in the startup stage. Software packages vary in price and complexity. Thank you.